What if we told you the world's most successful investor started his empire selling chewing gum and Coca-Cola door to door? What if you learned that his $100 billion fortune wasn't built on luck, but on discipline, patience, and a strategy anyone could follow? In today's episode on Finance Unpacked, we're diving deep into the life and lessons of the Oracle of Omaha, Warren Buffett. You'll discover how a shy boy from Nebraska became the world's greatest value investor, built a financial empire, and left behind a blueprint that could change the way you manage your money forever. Let's unpack the story. Humble beginnings in Omaha. Warren Buffett was born in 1930, right in the middle of the Great Depression. Growing up in Omaha, Nebraska, Buffett witnessed financial hardship all around him. His father, Howard Buffett, was a stockbroker and later a U.S. congressman, and it was from him that Warren inherited both his ethics and his first glimpse into the world of finance. By the age of 6, young Warren was already hustling, buying 6-packs of Coca-Cola from his grandfather's grocery store and reselling them door to door for a profit. At age 11, he made his first stock market investment, buying 3 shares of Citi's Service Preferred. The stock dipped soon after he bought it, teaching him an early lesson in patience and emotional discipline. When the stock finally rose, Buffett sold it for a small gain. But then he watched it skyrocket even higher. That moment taught him perhaps the most important lesson in investing: don't sell good assets too soon. A mentorship that changed everything. Buffett's obsession with money and business led him to the University of Pennsylvania and later to Columbia Business School, where he met the man who would shape his entire investment philosophy, Benjamin Graham, the father of value investing. Graham's book, The Intelligent Investor, would become Buffett's investing Bible. It preached buying undervalued companies with strong fundamentals and a margin of safety. It also warned against speculation, a trap Buffett avoided throughout his career. Under Graham's mentorship, Buffett developed a laser-sharp discipline: buy companies trading below their intrinsic value, hold them for the long term, and let compounding work its magic. But there was a twist. While Graham believed in buying cigar-butt stocks, companies that had one last puff left, Buffett's future partner, Charlie Munger, would help him evolve that thinking later on. The Buffett Partnership. After graduating and returning to Omaha, Buffett started the Buffett Partnership Limited in 1956. He raised $105,000 from family and friends and ran the business from a small home office. Over the next 13 years, the partnership delivered average annual returns of 29.5%, more than doubling the performance of the S&P 500 at the time. Buffett applied strict criteria when picking stocks: a margin of safety, competent management, predictable earnings, reasonable valuation. But Buffett wasn't just picking stocks. He was creating a system, one rooted in discipline and long-term thinking, 2 traits that most retail investors still struggle with today. By the late 1960s, Buffett began to see signs of irrational exuberance in the markets. In 1969, he did the unthinkable. He shut down the partnership, returning capital to investors and pivoting his attention to something far bigger: Berkshire Hathaway. Building the Berkshire Empire. Originally a failing textile business, Berkshire Hathaway became Buffett's investment vehicle of choice. Though he admitted the textile business was a poor investment, it gave him a corporate structure to start buying other companies, wholly or in part. Over the years, Berkshire Hathaway became a holding company for dozens of iconic American brands. Dairy Queen, BNSF Railway, See's Candies, Coca-Cola, Apple, one of his biggest modern bets. But what made Berkshire unique wasn't just its portfolio, it was the business model. Through insurance operations like Geico and National Indemnity, Berkshire collected billions in float, money from premiums that could be invested long before any claims had to be paid out. This float gave Buffett what he called free leverage. While others borrowed money at interest, Buffett had access to capital at near zero cost. With that float, he made long-term bets on businesses he understood and trusted, most of which printed cash for decades. Buffett's timeless principles. If you're watching this video, chances are you're not managing a billion-dollar portfolio. But here's the good news: Buffett's principles work at any scale. Whether you're investing $1,000 or $10 million, here's what he teaches. Invest in what you understand. Buffett avoids hype-driven sectors like crypto or tech IPOs. If you can't explain a business to a 10-year-old, don't buy it. Patience is the edge, Buffett once said. The stock market is a device for transferring money from the impatient to the patient. Buy wonderful businesses at fair prices. Munger convinced Buffett that buying great companies, even at slightly higher valuations, would outperform over time. Avoid debt. Buffett stays away from leverage. He believes that no matter how good an opportunity looks, borrowing heavily to chase returns is a recipe for disaster. Let compounding do the work. Buffett became a billionaire after his 50s and accumulated over 90% of his net worth after turning 60. Compounding. He once said his favorite holding period is forever. The human side of the billionaire. Despite being one of the wealthiest people in the world, Buffett still lives in the same modest house he bought in 1958. He eats at McDonald's, drinks 5 Cokes a day, and doesn't own a smartphone. His frugality isn't just charming, it's intentional. Buffett focuses on what matters: time, relationships, and purpose. He's pledged to give away over 99% of his wealth to philanthropic causes, primarily through the Bill and Melinda Gates Foundation. His philosophy is simple: if you're in the lucky 1% of humanity, you owe it to the rest of humanity to think about the other 99%. What investors can learn from Buffett in 2025. So, how do we apply Buffett's lessons in today's high-tech, fast-moving financial landscape? White heavy checkmarks stick to fundamentals. Even in a world of AI and algorithmic trading, the best investors still win by focusing on cash flow, earnings, and business quality. White heavy checkmark: avoid fear and greed cycles. Buffett's famous quote, "Be fearful when others are greedy and greedy when others are fearful," is more relevant than ever in volatile markets. White heavy checkmark: think like a business owner, don't just buy stocks. Own pieces of businesses. Understand how they make money, their competitive moat, and how they weather downturns. White heavy checkmark: don't time the market. Buffett admits he doesn't know where the market is going in the short term. He just stays invested in quality and lets time do the heavy lifting. White heavy checkmark: keep it simple. You don't need 100 stocks or advanced options strategies. Buffett's portfolio is surprisingly concentrated in a few high-conviction bets. The art market and diversification. In recent years, Buffett has shown interest in diversification outside the stock market, not in crypto, but in real assets like art. As inflation soared, alternative investments gained traction. One platform bringing this concept to everyday investors is Masterworks. With art historically outperforming even gold during inflationary periods, platforms like Masterworks offer fractional ownership in multi-million-dollar paintings by artists like Basquiat and Banksy.